In this video, I will continue explaining the second part of our financial feasibility basic model. Um, so let's continue here with our income statement. We already have our first year, and then we need to project the next years. I make some changes here according to, in comparison with our previous videos, which I have different prices. Now I have my prices 50,000 and the unit cost 20. And the units one seller can sell a year is changed to 5,000. These are the only adjustments that I present. And I also have here the inflation rate for my 5 next years. My interest rate, which is the rate of my loans. I have a 20% on depreciation rate. That means that my assets that could be depreciated will be depreciated 20% every year. That would be a 5-year depreciation term. And my growth of sales is 10% each year. So here I have my new quantity, which is 10,000. So for next year, it will be equal to previous times 1 plus my growth of sales in quantity. Again, F4, so we fix it, this percentage, and we can drag it to the right. Enter. And then I fill the next year. So you notice how my sales increase at a pace of 10% a year. My revenue is this quantity times price. And in this model, the prices stay the same. We don't increase the price nor the cost, which is established at 20,000 for the whole 5 years. And then our gross profit, it should increase every year because there is an increase in the quantity. Then my fixed expenses won't change on the first year, but on the second year they need to increase at the inflation rate, because rent will be increased at the inflation rate. Also some expenses, administrative expenses and salaries, should increase also at the inflation. So again, in order to increase this times open parenthesis 1 plus my inflation rate, which should be fixed, it's F4 in my keyboard, close parentheses, and then I drag it to the right. For my variable expenses, I make a little change with my salaries on sales, and this change is right here. I make my new formula. This middle term here is changed. In the previous video, I only had this cell, the B17, selected, but I noticed that if we increase the quantity of cells here, we won't make a change down below. So we need to make a change. And the change is here I selected the salaries for sellers, which is on D16 right here on top, 1,092,100, times my quantity, which is 10 and the first year, divided by the capacity of sales per seller, which I established it at 5,000. And that's the only change I made, and the rest is the same as in the previous video. So I only need to drag it, and you notice that the variable expense increases at the pace of the quantity increase. So operating profits, only need to drag it, will be the same, and my interest expense is supposed to be the same because I do not make any amortization on capital. And my profit after tax, it will stay the same. The only projection we need to complete our first task is to estimate the initial balance sheet. We don't need to project the balance sheet, only the first initial balance sheet, so we could have a better idea of our financial needs and necessary investments. So it is only a matter of linking to this data, to the data on top. So the cash is right on top, estimated at 10 million, because that's the money I need liquid, so I can pay all my obligations every month. Inventory, I estimated at 30 million pesos. It should be, and it could be different in your cases. Current assets is the addition of cash and inventory. Notice that I don't have receivables. I don't have those sales, credit sales, because this is a starting business, and my business model is only cash sales. So no business should have liabilities unless you are buying an existing business. Furniture, fixtures, plant and equipment is already established there, so it's just a matter of linking the data to the one on top, and the long-term assets is the previous addition you are just looking at. So total assets is the addition of current plus long-term assets, and liabilities is only this. So these two numbers should be equal, total assets equal to liabilities and equity. And that would be it. Thank you for watching.